This is the Self Storage Podcast, where we share the knowledge and skills from the industry's leading investors, developers, and operators to help you launch and grow your self-storage business. I'm your host, Scott Meyers, and over the past 16 years, we have acquired, developed, converted, and syndicated over 2 million square feet of self-storage nationwide with the help of my incredible team at selfstorageinvesting.com, who has helped thousands of people achieve greatness in self-storage. One of the biggest changes to the self-storage investing landscape during the pandemic and the current recession is the availability of capital that is coming out of Wall Street and directly into self-storage projects due to the recession-resistant nature of our industry. And if you haven't prepared for this rapid shift, you may be missing out on the single biggest opportunity to dip your bucket into the river of money flowing into partnerships and syndications that are acquiring or developing self-storage. Well, my guests today are two of the most knowledgeable SEC attorneys in the country. Jillian Sidoti is an attorney, speaker, entrepreneur, mother, and former college professor who has written equity and debt offerings for all kinds of industries, including real estate, biotech, film, software, alcoholic beverage, cannabis, and green tech. Jillian is also the author of the Crowdfunding Myth and is the founding partner of Crowdfunding Lawyers, LLP. Clients have gone on to raise over $4 billion in capital since 2014. Her partner, Nancee Tegeder, advises clients on matters related to crowdfunding, syndications, commercial real estate transactions, and securities laws, and is the leading expert on opportunity zone funds at their firm. Prior to working with Jillian, Nancee has served as an in-house counsel for multiple small businesses, advising them on business structure, intellectual property matters, and contract law, and also owned her own estate planning law firm in Arizona for 5 years. So without further ado, let's dive into my conversation with Jillian Sidoti and Nancee Tegeder. Jillian and Nancee, welcome to the show.
Thanks, Scott, for having us.
Well, so glad you guys could take some time out. I gave everybody a little information on your background and your bio. So if I could, why don't the both of you, since that was written and sent over, why don't you tell us what has changed since then, since we are in an ever-changing environment and landscape right now, either in your positions and what you're doing for folks at the firm, and then also we'll dive in after that as to getting the lay of the land and the environment that we're in. So Jillian, why don't you start?
Oh, yeah. Well, thank you. So right now, we've got 3 lawyers in the firm, and we're making some real progress in helping people navigate this new post-COVID world of putting together legal documents. But one of the exciting things we're going to start doing is I'm going to actually step out of my role as a lawyer and start consulting with people on their full money raising venture. That, one of the things we see that's really lacking in the industry right now is that a lot of our clients or potential clients who come to us aren't really ready to have their legal documents done because they haven't done the work ahead of time. They haven't looked for investors. They haven't set up things where it's easy for the investors to get to them. They haven't put out reasons for investors to actually, the whys of why investors would invest with them. They haven't told the story of their investment opportunity. And so one of the things I really am looking forward to doing is helping potential syndicators and fund managers with navigating that, and then also navigating what to do with investors once you have them in the door, and making sure that reporting is happening and is efficient, and your investors are happy little investors who come back and invest more and more and more money.
Always been important pre-COVID. That's just a part of raising capital and having limited partners. But I think even more so now, one of the good things that has come out of this is that we do expect more in terms of communication. A phone call doesn't do anymore. It has to be a video call, and on a more regular basis, on all across the landscape in terms of a business. And so I think the timing is right for that. So I'm glad to hear that. Nancee, how about yourself? How have things changed for you?
So one thing we've done is we've gone completely virtual, which I think most everyone has. We all work from our different locations. So like you were saying, we got to do a lot more video calls to stay connected. Jillian and I have talked a lot about the makeup of our firm and the roles we're playing. So I'm going to maintain the legal side of things. So her plan as a consultant is to really prepare our clients who are coming to us. And then I will take them from that point forward and do all their legal work, get them set up, ready to go, and then can hand them back to Jillian to continue the process on. So we really are trying to offer more of a full service to the potential clients that we have, but in a way that I can keep up on the legal side of things and she can do things that are outside the scope of just the legal role, because we see there's a great need for that.
Well, there's a great need for many things in this, well, in the times that we find ourselves in right now. And there's always the underlying questions when it comes to raising private equity, especially when people are starting out. And this environment has proven to be maybe a little more opportunistic, but then also more difficult. So before we got on camera, we were talking about the two main questions, which is what you help people with, or at least now we'll be able to guide more in consulting. And that is, where do we find folks? Where do we find the money, the partners to invest in our deals? And then what do we give them? What attracts them? What do the distributions look like? So um, we can talk about the history of that, but I think what everybody really wants to know, including myself, as we continue to put projects out there to see, what is going to be the most, what people are going to be the most interested in terms of distributions. Tell us a little bit about what you're seeing in the marketplace right now in terms of, let's start with distributions first and what attracts investors, and then we'll talk about maybe the pools and places where we can find these folks.
I just want to start with that a little bit. Oh, sorry. Is that okay?
Yeah. Well, before you talk about what distributions are good, I want to emphasize that distributions are secondary to the story itself.
Mm-hmm.
Right.
I could say I'm going to give you 8% preferred return, 80-20 split. That doesn't mean anything. That means nothing without the story behind the opportunity. It doesn't, if you haven't emotionally hit on that investor or, spoken to that investor's other needs other than return on investment, or built a level of trust with that investor, I could tell you it's 52% return on investment, and that would mean nothing, absolutely nothing. So Nancee, I'll let you pick up on what do distributions really look like.
No, and that's exactly right. And we see ranges. I see some down 6-7%, where you might think, oh, that's maybe on the lower end, but they have a trusted network of people who are willing to at least put in for that return versus maybe something up to 15 or 20. So we always say it depends. That's the best answer lawyers give. I can give some generalities of what we see, but I don't want you to feel like you're locked into those numbers. It's going to be individual for each person. And what I might say is a general distribution. If you apply that to your specific case, you might walk away not making any money off your deal. And we don't want that to happen either. So keep these generalities in mind, but definitely talk to someone to make sure they fit your scenario. There's different ranges, and there's so many ways to massage these numbers to get to your end result. So you can look at your end expected internal rate of return. I say shoot average 12 to 15%, but how you get there, there's a number of ways. You want to be paid as a manager, so you might take some management fees up front. You may want to give your investors preferred returns before you do splits on the back end. You might just do a greater split. So very common is to see a preferred return somewhere between 7 to 9%, and then a split on the back end, maybe a 70 to your investors, 30 to the manager. And I say this so generally because I don't want you to feel like you have to keep to these numbers. One is looking at your story, like Jillian says, make sure you have that trust with your investors, and whether it's, a 14% versus a 15%, that's not going to make or break your deal.
And all good, because we've had a couple of projects that have come out post-COVID and had more interest on our webinar, more attendees, more folks that will pull down the offering memorandums from our portal and review, yet more questions and fewer people initially getting involved. And we've done a 506C. For those who aren't familiar with the 506C, it means it allows us to go out and advertise and promote this without having a prior relationship with folks. And this will be the first time that we've done that. So assuming that we cast a wider net, we get more people interested in it, as long as we put out the right types of IRR and multiple and preferred returns in place, what we're seeing across the market, that we would get a number of folks interested and be able to fill these projects up very quickly. And we found, I wouldn't say just the opposite of that, but it didn't meet our expectations in terms of the timing. So we decided to dig in and begin placing the phone calls to the folks that, starting with the ones that pulled down the package, and even some of our normal investors who always, almost always invest in every single project of ours. And so we called some of those folks back and, just asked, hey, what's just curious, what didn't you like about this project? And what, all else being equal, to your point, Jillian. Promoters, we've been doing this for a number of years. We've been in the business for a while. The projects are strong projects. Their value, one was value add and one was development. And so once we begin, placing the calls to them, one of the variables was a longer time frame. So normally we're out in 5 years, and this one was a little bit longer. So that was one of the challenges. But we had many, many more questions regarding the story. It did not have enough value add. The reason why that seller was retiring didn't seem good enough. It seems like there was more folks that wanted to live vicariously through this project as if it were their own. They couldn't hang their hat on it, and they wanted to perhaps be able to tell this story to their friends of what they're investing in, or their spouse or whomever. And the story just wasn't, I don't even want to say sexy enough to make it sound like it has to be really juicy in terms of the returns, but really it's like something that they would be proud to own or talk about. It's like they're waiting for a better story, all things being equal in terms of IRR and time frame and everything else. So it's interesting times that we're in right now.
Okay, can you tell me, and I'm sorry, forgive me that I don't know which deal you're talking about, but can you tell me what the deal was?
This is a boat and RV facility in Florida.
A boat and RV facility in Florida. And was this one ground up construction? Is that the one I'm
It is
thinking
not.
of?
It's an existing facility, value add, not much to do, but add technology and run it a little bit better, bring it into normal times, add some income streams, nothing in the way of expansion, maybe putting canopies in, but just continue to turn it around, raise rates. There's a moratorium from other facilities in the market. And it's a 7-year more cash flow play, and we started distributions right away.
Okay, there's a lot of story there, and
There
you
is.
just really downplayed it quite a bit. So the things you want to talk about are, first of all, the technology thing is huge. I remember I went to a presentation once on how artificial intelligence is truly taking over and will make a better world for all of us, including better investment opportunities. And you just that was the first thing you described, was that we can add technology. I'd talk about the technological advances in self-storage and how you followed them, and how you're looking to implement them to make a better experience for not just the owner and investors, but also in a better experience for the person who needs to store their stuff. And unfortunately, we're coming up on a time where we're probably going to see a lot of people needing self-storage more than ever, because they're going to need to downsize, and baby boomers are going to be moving into more assisted living facilities, and they don't want to get rid of their things. Their things are precious to them, and we're giving them this opportunity to store their things in a safe and secure environment with some of the best technology that's available in self-storage today. I mean, your story's a good story. You just got to tell it better.
It is. Oh, it's me.
No offense.
I want to add on to your story, because my husband and I, we are big boaters. He actually, his business is, he as an engineer, he makes boating accessories. This is not a plug for his business. But what my point with that is, when we were shopping for homes, we always had to look for a garage or a space to store our boat, and that's very hard to find.
Yes.
And especially if people are downsizing, you don't want to give up your boat. That's a really precious thing to boaters. And so to provide, I know more of the deals I've done with you are just self-storage. This is one of that with the boating and RV, I liked that twist. That appealed to me more because I am a boater. But I thought, how are the rates comparing to everyone else around there? What lakes are there? How close are they to that storage place? Because you want your boat near the lake. So things really targeting those boat owners would be more of an interest to me as well.
So I don't want to turn this episode into let's help Scott with his capital raises and
no, but I think it helps other people if they see.
It is.
But go ahead, it's your show. Well, you can do whatever you want.
But that does lead into the next question that we have around fear that we've been asking ourselves, that I'm sure other folks do as well, which is, In terms of the project itself and the value add and all the things that we can provide to that, there still is the underlying. I'll ask this maybe in two ways. The underlying question of, well, what do we put out in terms of a preferred return? Do we offer one, first of all, and how much is that? The time frame in which somebody's their capital is going to be tied up in a project, 3, 5, 7 years, and sometimes it's just dictated by the investment. And then an overall IRR that we're shooting for, what does that look like? And we know the equity split is going to be dictated by the IRR that we're aiming towards. So we've got projects that we put out that have no preferred return, and some that have just a modest an 8% preferred return, and the IRR ends up being the same on these projects. So I guess all things being equal, and if I look at my own list, I imagine there's some folks that need a preferred return or want it, and others that are okay as they're wealth building. But what would you say to folks that are maybe starting out right now without getting to the place where I feel as if we have conditioned our list that if they see a project come out that doesn't have a preferred return, then they're automatically not interested because we've kind of groomed them to get used to that. So let me turn that back around by saying, how do we do that? How do we keep our list up fresh so that they're interested in all the projects that we come out with, rather than just coming out with the same at all times? And if we do want to do that, what does that look like? Does it always include a preferred return? Do we mix it up? Is that a good way to go about doing this? What kind of suggestions or recommendations would you give to folks as they're starting out, so as to make sure that years down the road they still have enough folks that are interested in their projects as they come out, even if they do look different from one to the next?
I think at the end of the day, go ahead, Nancee, I'm sorry.
I always recommend for your first deal, be more generous to your investors, because if you can start a track record of them getting a good return, that's going to make them want to come back and invest in other projects. And it will be more appealing to them up front to give them that higher return. Now, figuring out what that is, you really want to look at your financials and look at what you expect to make from this project overall. What are you going to gross? And then decide, how much do you want to be paid to make it worth your time to invest in these projects? And then whatever amount is left over, you can figure out how to divvy that up, whether with the preferred return or the split. But that's what I'm talking about when you massage those numbers. So with the preferred return, one thing I do want to focus on for people to be thinking about if they're deciding whether to do that or not, there's really two types. There's the cumulative and the non-cumulative. I think this is important and hard to understand, but once you get it, then it starts to make sense. So let's say you offer an annual 8% preferred return, cumulative. That means every quarter they're going to get a 2% of that on their preferred return. So if they put in the 10,000, then they're going to get back, I hate doing the numbers on this, the 2% on that, okay, I'm not gonna do math on the spot. I'm just gonna mess it up, I know. But my point is, if you don't have the funding for that quarter, if it's cumulative, that amount you owe will roll into the next quarter and you'd actually pay 4%. So cumulative is going to be more appealing for an investor. If you do non-cumulative, if you don't have that 2% in a particular quarter, you just don't pay it. You go to the next quarter and pay that 2% again when you have it, which is easier for the promoter or the issuer, but definitely not as appealing for your investor.
And in that instance, in a non-cumulative, if you were to offer that, say, on a development project, you wouldn't even begin paying that preferred return until years 2 or 3 when it begins to cash flow, correct?
That's exactly right. And sometimes that's a way to incentivize people to get in, knowing, hey, I'm not going to be getting any return for 2 years because we're developing, but at least my preferred return will be accumulating over that time period. So it'll pay off the long term. So someone needing cash flow immediately, maybe this isn't the best deal for them to invest in.
Jillian, what would you add to that?
I would just say again that you really, what you can do is you can always put your best foot forward. And what I would start focusing on is if you're moving people towards a an offering that doesn't have a return, a preferred return, to focus on why you're doing that presents some kind of advantage to the investors, if indeed they even question it, right? Because I believe, again, if you step forth with a good story and you get them emotionally involved in the project, and the returns, like, unless you're like, and you're going to make -2%, or you're only going to make as much as that's in a money market or a CD or something like that, unless you're doing things like that, which are, obviously not going to work, you'll have a better opportunity of how to sell it. So if you have if you're telling an investor who's invested with you for a really long time that I'm no longer giving you a preferred return, you don't start with that. Instead, you say, look, we're mindful of the cash flow needs of this particular project because it's such an exciting new project that is cash flow heavy in the beginning. And we want to under promise and overperform. And the only way we believe we can do that is by putting most of the returns, which we believe will be very healthy returns, on the back end. And so that's why we're doing this. But I also want to point out that not only are we not doing a preferred return, our fees, according to the industry standard, an asset management fee can be anywhere from 1% to 3%, and we're only charging 1.5%. An acquisition fee can be anywhere from 1% to 6%, and we're only charging 1%. And you start taking, not pointing towards the negative reasons of not having a preferred return, like, we're just sick of watching so much money go out the window, which is oftentimes what, experienced syndicators realize. They're like, I'm not getting paid enough to do this anymore. So you move it away from that and instead move it towards the positive things and the real reasons why. We're looking to under promise and overperform. We're looking to really make sure we have the cash flow sufficient to make any improvements. And if we're worried about making preferred returns, we're not going to be able to make those improvements, which is not good for anybody. And our fee structure is relatively low. Now, those might not be your things that you point to, but you want to start thinking about what are the good things about this. And then you can also go outside of your own project, right? You can also say things like, look, there's a lot of uncertainty in the stock market now. We just saw Facebook, I'm a huge Facebook investor. I invested right after their IPO. I've made a lot of money in Facebook. Thank you, Mark Zuckerberg. But you know what this news has been about Facebook in the last couple of days that I would use as to my advantage if I were in your situation? Look at Facebook stock. Coca-Cola pulled out advertising on Facebook because they were afraid of how Facebook was going to influence the election, and they're making a political move, and therefore Facebook stock lost blankety blank in value. If a company like Facebook can lose value during COVID-19, what's going to happen to other stock market companies? This is why you need to be in a hard, real asset like real estate, especially an emerging asset class such as self-storage that is going to be very much needed if in fact there is a downturn. But regardless of the downturn, there's also the needs of baby boomers who are aging and will probably not be aging in place, and so will downsize and need places to put their stuff. So you take it away, turn it away from the negative aspects of you and turn towards some other negative aspects in the industry. It's all very sneaky, but it's all very useful and truthful.
Well, I don't even think it's sneaky. I'm probably the worst salesperson in the world, which I think makes me a better syndicator and promoter, because I don't want anybody to get caught up in any hype, nor am I going to induce any hype. Plus the old adage in raising private equity, and I think I got this from you, Jillian, years ago, is that a person convinced against his will is of the same opinion still. So if you're really working hard to convince somebody to invest in your deal, you're not going to, and that doesn't bode well, and people can see through that. And so when I say I'm not a good salesperson, it means that I will rely on all third-party sources to draw them to the logical conclusion, so that by the end of a pitch, if you want to call it in air quotes, or our presentation, the only reason that they wouldn't want to invest is something outside of the fact that they don't feel that they're going to lose money, and that they know or feel confident they're going to make money. And this is solid than everything that we've said, because not because of what Scott said, but because of all of the press clippings, the articles, the stats, the industry stats, and all the third-party references as to how well self-storage does during a recession, and what we've done over the past 12 months, and this particular project, the market, the area. So I don't think you can ever have enough of that data and information when it comes to making that pitch to someone, up to and including, hey, What has the stock market done? Oh, by the way, well, here's another slide showing how self-storage has outpaced the S&P 500 for the past, 20 plus years. And so I believe anytime that you're making a pitch for a project and asking somebody for money, that there is no hype, that you are monotone throughout that presentation and only pointing out to things in the marketplace that has nothing to do with you. And maybe not even so much your performance on this particular project because you haven't done anything yet, but on the past and what you've done. That's at least in my opinion, that is the best way to be able to put somebody in a position to be interested. And then the fact that, as you mentioned, Nancee, starting out, I think you do have to offer a little higher, perhaps a pref to begin with, a little higher splits as you're starting out to separate yourself from the pack, because what they have that you don't is experience, and that those folks have already purchased, created value, and sold some type of real estate, and then given their investors that money back. But if you don't, that's a little bit riskier, and that may be the instance in which you decide to put your best foot forward and give up a little bit more. So all that said, for folks that are starting out right now, what is we don't have a magic wand and we don't have a magic number. So let's talk about how they put themselves in the best position right now to be able to get these limited partners, a number of them, to invest in their project. And then where do they go out and find some of those folks, where they need to be hanging out, and how do they attract folks to their projects?
Okay, so you can't hang out a lot of places right now, right?
Good point.
So what you really should be doing is, attending as many online social events as you possibly can. This isn't like a huge investment of time. And then if you're a little more shy and you don't want to be attending a social events online, then be a keyboard warrior. And what I mean by this is that you need to start adding value to people in obviously online settings. People aren't going to find you sitting in your house at your kitchen table. So I'm sorry if you've never liked being online, or you've been shy about being online. This is not the time to retreat. You have to get out there and you have to start talking to people, because you're not going to go down to the local watering hole or RIA meeting and be able to network in person. So how do we get to reach out to people? We start adding value and adding content like we're doing right now, and sharing what you know. And oftentimes what I get when people are coming to a class of mine, or in these situations where they're still learning, or I guess we're all still learning it, at various points in our lives. But when they're still learning this, for example, or they feel like they don't have a lot of experiences, teach as you learn. And one thing I do at live events is I'll tell people, take out your phone right now and post one thing on Facebook that you just learned, that just blew your mind, that just blah, and you can tag me or whatever. And that's just building a credibility snowball. It's showing that you have spent time investing, you've spent money investing in your own education so that you can bring opportunities to other people. One of my favorite stories that I tell is about one of my best friends from Chicago, very educated woman, made a lot of money, was a software salesperson, single, wanted to get into real estate investing. And when I said to her, you should take some classes, her response to me is, I don't want to do that. I don't want to take any classes. I just want to write you a check and you tell me what to do. Like, there's more people out there like her than there are people like you who are watching this, who are willing to spend their time to get educated. So you just need to find those people. And the way you find those people is you draw them towards you, not you actively necessarily look for them, but you rather add value online. I just learned this. Did you guys know this? What do you think about this? And you know what? I said something there at the end that's also a great way to get people engaged. What do you think about this? Because everyone has an opinion and wants to give it to you, no matter what. I could go out on Facebook right now and go, which is better, Burger King or McDonald's, and watch what happens next.
Especially on Facebook, right?
Yeah.
No, I'm visiting my nephew right now, or my family. My nephew's 20 years old, and he wants to get into real estate investing. He has zero assets, hardly any network, that he is so motivated. And that was exactly my advice to him. I said, start establishing yourself as an expert in this industry. Get on Facebook, get on LinkedIn, get on Instagram. Just start posting anytime you learn something or doing anything, and get your reputation out there, because as people start to, like, you find those people. I know so many people who have money, they want to invest, but they don't want to deal with landlording or development. They don't want to do any of that. But they know, oh, hey, my nephew's got this experience and this expertise, and now I'll just let him try that, and I know him. It's really hard when clients come to us and they're ready to start this deal and they have their property and they've done zero networking. So I hope anybody who's watching this, start now. Even if you don't have a project, even if you don't have a deal, just start talking to people about what you do. Start putting that vibe out into the universe, so that when the time comes, you already have some of these relationships established, and it'll be a lot easier for you to raise that money.
That we learned that very early on. We have an education company where we teach people how to invest in self-storage, and there's folks that have been working up with us for a number of years, have been to our events, have gone through maybe some mentoring programs as well. And then at the end of the day, they decided, they thought, well, I don't think I want to go through all of that work and the heavy lifting. And if I can get the types of returns that you're promoting, and I can do that in a passive manner, and then still get to learn and come along for the ride, and have ownership and have that on my resume and a K1 for when I want to go and do this on my own, I can show the banker that I do have ownership in a self-storage facility. That ticks a lot of boxes for a lot of folks, more so than I ever would have expected. And we do have a number of folks that truly started out going down the path where they wanted to be actively involved in commercial real estate or self-storage specifically, and then just found that this was a better path to go with the least resistance and still had the returns that they were looking for. So never discount the fact that by you going out and contributing, doing your best to be someone that is well known in the industry, that yes, that will actually that will pay off in spades when it comes to networking and then just telling your story. So that being said, tell us a little bit about, let's talk situational and drill down a little bit more the environment that we're in right now, in terms of, and I don't even have a specific question other than to, let's just talk about the flow of money. We know we have folks that are coming out of the stock market that have lost a lot of money, or they've lost cash flow. They were, generating returns based on in some types of securities that were generating cash flow. Hard assets is where they're retreating to now, income producing hard assets, because it can't go away overnight like so much of the other vapor on paper up there in the big casino on Wall Street. So for those that are involved in real estate, what are you seeing out there in terms of the flow of money? We know it hasn't gone anywhere. It's still there, but is it moving readily? Are we starting to see an uptick? Where are we at in this cycle right now?
I don't feel like we have slowed down at all. Work has continued to flow. Just, you said the money's still there. It's just where it's going. I'm seeing, I would say the majority of what we're seeing right now would probably be blind pools or opportunistic funds. People know opportunities are coming in the pipeline. I just had one client who had this deal all lined up, ready to go. And then someone came in with the cash to do it, and they didn't have it ready. And they said, we don't want to lose out on any more opportunities like that. So we're going to get our fund together, so we're ready the next time that one pops up. But I'm seeing the most interest in that probably.
Nancee, before I have Jillian weigh in, explain to everyone what an opportunistic fund is.
Sure. So it's like a blind pool, or you could have it for self-storage generally. But what it means is you pick your amount of money you're going to raise, your investors come in, but you don't have a specific property identified. You just have maybe certain parameters, maybe just development or existing self-storage value add, something that you're going to focus on and look for out there in the market, but you have not quite yet identified. So you raise that money and have it ready to go. So when the opportunity presents itself, you're ready to invest, and you don't have to go out and then raise money for a month and lose out on that deal.
Like a traditional blind pool or a fund, you're advertising a certain IRR, correct, on that?
Yeah, you establish all that beforehand, exactly.
Perfect. All right. Jillian, what are you seeing?
I'm not really seeing, again, anything slow down. I'm just seeing the opportunities change a little slightly. For example, we're seeing more biotech opportunities. Like there's a huge uptick, obviously, in there's a huge uptick in biotech opportunities, but there's also an appetite to take a risk on biotech opportunities right now, because there's this feeling out there, I think, that people are going to or people, I guess the government is going to just let scientists get certain biotech opportunities through the FDA a lot faster. That's actually a real thing right now. So I think people are more willing to invest and take chances on what otherwise are high risk opportunities in biotech. And then also the flavor of real estate is changing a little bit, because we're seeing a complete abandonment of anything office/retail, and in some senses even a complete abandonment of luxury homes. So and a complete acceptance of a fund model, self-storage, and some multifamily.
Mm-hmm. Mm-hmm. Well, where our discussion is heading after this, as we talked before, and our stance on self-storage for all those reasons that you had mentioned, Jillian. We are extremely excited about the opportunities that present us during a recession, and we have been preparing since 2011, essentially, and lining up more and growing our list of private equity investors, and doing things in a way that is, put us in a position to be able to raise the capital for these. But looking now to turn that up, and the Opportunistic Fund is one that we have had a discussion about, and most likely we'll be heading that direction very soon, as we see that with unemployment nearing 40 million now, we know that there's going to be downsizing, and of all the businesses that already have closed, and many are putting their items from the office equipment to the machinery to excess inventory, and anything else is rushing into the self-storage facilities, including our own right now. And so we know in the next 6 to 9 months that's going to change again when everybody's time runs out and foreclosures begin, and have to move back home with their parents and with each other. So again, we do not. Yeah, I know it's an awful feeling, isn't it? But we do not celebrate pandemics. We do not celebrate recessions, but we know the position that we're in right now in this industry is one that does benefit from this perfect storm. And we have low interest rates right now, so we are very, very bullish. And caffeine has been our friend around here recently for all the opportunities that we're looking at. So with that, I want to say, first of all, thanks to both of you. But what if you could, for parting words of wisdom, resources, tools, anything on your mind recently that you want to leave with the folks before we wrap up for the day?
I'll go with that for a second. For me, what's really important, and one of the reasons why we're trying to move from being a law firm that just does your legal documents to providing some of these other things that we so desperately think money raisers need, is to really analyze your before, during, and after of your money raising strategy. You touched on this, Scott. If you set it up and you set expectations in a certain manner and you don't manage those expectations appropriately, you and your investors are going to be sorely disappointed. So that's why the before is so important. The before drives the during. And then if you don't take care of your investors in the after, or report to them properly, or manage their expectations properly, or check in with them in a manner that is consistent with what you told them in the before and the during, then you're going to have investors who are not going to come back, who aren't going to invest in the next deal, who aren't going to tell their friends and family. The more exciting you can make this passive investment opportunity for your investors, and the more trust you build throughout the entire process, and the trust you maintain, the better off all of you are going to be.
Mm-hmm. Yeah, absolutely. That's a good way to sum it up. Thank you, Jillian. Nancee, what would you add?
Yeah, just my final thought is, you can be successful. We see all sorts of people come through, and we see some who don't do so well, and some that do great and continue on and are growing. And the difference I see between those two types of clients are those who are willing to put in the work. This isn't a free ride, but as long as you are out there continually working hard, looking for deals, marketing, and doing all the things we tell you to do and that Scott tells you to do, as long as you're willing to put that work in, you will be successful. It's those who think this is just easy money and you find a good deal and you get some people to put money in and you're good to go. Those don't see as much success. But I really love watching those who first start out and have put all this work in and they're doing fabulous. Even in this market, they're doing great. So it is possible.
Well, that goes for the real estate side of the business as well as the private equity side. None of this is a hobby. None of this is a set it and forget it business. You have to walk the four corners and just absolute relentless pursuit of improving at all costs, and then letting your clients know and communicate to them what you are doing and how hard you are working for them. That is the difference. So I couldn't agree more. Well, Jillian and Nancee, we could talk for hours. We could talk 30,000 foot and we could get very granular. This is just a piece that I absolutely love, just the art and the science and the deployment of this whole process of raising private equity and putting deals together. It's matching the good deals up with the investors who are interested in coming along with you. And there's just nothing more gratifying than that. And I absolutely love it. And we are so thankful to have you two guiding us and our clients along the way as well. So with that, what is the best way to reach you and your firm for consulting, help, assistance, setting up funds, and everything else that you do to help folks like us?
So you can go to our website. It's crowdfundinglawyers.net. And on there, we have a scheduling calendar, so you can reach us that way. Or our emails are just our first name. So Nancee's 2 E's or Jillian at crowdfundinglawyers.net. Those are probably the best ways to get a hold of us.
Perfect. Well, once again, Jillian and Nancee, thank you so much for your time. Looking forward to the time when we can see each other in person, whether it be at a live event, mastermind, or just getting together and drinking wine in Temecula. So hopefully,
that would be great.
Yes, it will be. So thanks again to both of you. Have a great day.
Thanks, Scott.
Ladies and gentlemen, thank you for listening as always. Now, we're going to be talking about topics like this that are on target for the times that we find ourselves in. So it is important that you are listening to this podcast every single week because the guests that I'm going to be bringing on and the topics we will be covering are relevant to what we are all going through right now. And it's just going to get better and better and better in terms of the content that we're going to be discussing, and it's going to be more timely than ever. So please, make sure you subscribe to the show and make sure you're paying attention to these episodes as they are coming out during this period, as I am specifically going out and finding guests who are providing really valuable information you need right now. So thank you so much. We'll see you next week.